Hello, this is Bob Steele. In this lecture, we will take a look at Chapter 11, Current Liabilities and Payroll Accounting. So before we jump in here, I want to just take a look at a trial balance real quick and see where we are at on it. So remember, a trial balance is going to have a T accounts. T is here. The assets will be on top. These are all assets in the green. We have liabilities. That's where we're going to be spending our time most of the time, with both liabilities in terms of general liabilities, current and long-term, and in terms of payroll liabilities will be in this section here. Then we have the owner's equity, the income, and the expenses, and of course the total debits equal the total credits, which can also be represented in our accounting equation: assets equal liabilities plus owner's equity, as shown here. So that's where we're at. We're going to focus in on this area. We will first define liabilities like so. We're going to say that due to a past event, a company has a present obligation for future sacrifices. So what does a liability represent? It means we either bought an asset or we incurred an expense. We got an expense sometime in the past and have not yet paid for it in some way, and therefore we generally owe something in the future. Often cash. Doesn't have to be cash that we owe. We may owe our services or something other than cash in the future for something that we either purchased in the past or consumed in the past in the goal of generating revenue, which is our business objective. Classifying liabilities. So we're going to have current liabilities, we're going to have long-term liabilities. This is kind of an arbitrary definition of short-term and long-term liabilities. The reason we want to do this is because we need to know if we have enough current assets, meaning cash, things that will become cash relatively soon, in order to pay our current liabilities. So that's going to be a liquidity type of ratio. So it's very possible for us to have a lot of assets, but not enough to pay our current liabilities, because our assets could be tied up in long-term assets, and we might have a lot of short-term liabilities. So expect it to be paid within 1 year or the company's operating cycle. That's a current liability. Once again, the 1 year is kind of arbitrary, but it's a good number to use because it gives us an idea of what's really coming up fairly soon within the next year, and do we have the resources to cover those liabilities that we're going to have to pay fairly soon, as opposed to long-term liabilities are not expected to be paid within 1 year or a company's cycle. So longer-term liabilities, we're going to have to pay them, but we don't have to worry about them at this moment immediately, and therefore we may not need to tie up some of our current assets. We might be able to use those current assets in a more efficient way if we don't have to pay the liabilities off in the near future. So different companies are going to have different kind of ratios in terms of how much current liabilities as a percentage of total liabilities. And so Six Flags is at 12% versus the Bowl America at 55 versus Apple at 70. And of course, these differences could vary based on the industry and the needs of different industries. So uncertainty of liabilities. So uncertainty in whom to pay, uncertainty in when to pay, uncertainty in how to pay. Those are the three things we need to know when we think about liabilities: is who are we paying, when are we going to pay it, how much do we pay. Normally that's pretty straightforward. I mean, if we had a business transaction, we bought inventory on account, we know who we bought it from, we know we have to pay it within basically 30 days or so, and we know how much it was. But there are some liabilities out there that may be more uncertain, such as, what if we were going to have a lawsuit, and if we lost the lawsuit, it could be $1 million. If we win the lawsuit, then we don't have any money. And the question is, how certain is it that we will lose the lawsuit? Therefore, do we have to record something like a lawsuit? And if we do, then how much do we record it for if we don't know exactly the range? So these are some items when the uncertainty can be there, and they are obviously substantial. If we've got a substantial lawsuit out there, we would want to inform our readers of the financial statements in some way if it was going to be something that we think is going to be incurred sometime in the future, even if it's not completely certain. So most of the stuff we're going to look at is fairly certain from a day-to-day business transactions. There are those, though, that are not always in that way. So known liabilities will be things like accounts payable, sales taxes payable, unearned revenues, short-term notes payable, payroll liabilities, and multi-period known liabilities. So these are things we basically know. I know when the payroll, I know who I owe, I know who worked, I know when we're going to pay them. Sales taxes, we know how much sales we made, we got to pay it within like a month or two of the sale. We know that the unearned revenue means we collected revenue, but we haven't done the work. In that case, we owe the work, not necessarily the cash, Short-term notes payable, usually there's a contract on it. We know what's going to happen there. Payroll liabilities, once again, we know who we paid and what we owe. And multi-period known liabilities is long-term liabilities that may have a short-term and long-term piece to them, which we'll talk about in a second. So sales tax payable on August 31st, Home Depot sold materials for $6,000 that are subject to a 5% sales tax. So if we sell something just like any sale, if we got cash, we're going to debit cash, making cash go up because cash is a debit balance. We need to make it go up by doing the same thing, which is another debit. We know we're going to credit sales because sales has a credit balance and it only goes up, and we're going to make it go up by doing the same thing to it, which is a credit to sales, which will make net income go up. The difference being here is this is what we sell it for. Now we're going to take into account the sales tax. So we had to take that $6,000 times 5% sales tax. Sales tax could vary from state to state. In this case, we're having a 5% sales tax. We don't get to keep that sales tax. Therefore, we're going to credit the payable, which in this case is a liability. It is a liability. Anytime it says payable, it's generally a liability. Liabilities of credit balance, we're going to make it go up by crediting it. The debit's going to be the $6,000 sale plus the $300 that we're going to receive from the customer in order to cover our sales price plus the sales tax. But the $300 we can't credit to revenue because we don't get to keep it. It's not our money that we earned. We have to pay it to the government. Then we have unearned revenue, is one of the more complicated ones. For most people, it's not something that happens in every company. Certain companies will have unearned revenue, such as sells $5 million in tickets for 8 concerts. So if we sold the tickets, we sold them before we did the concert. So therefore, we're going to debit cash because we already got the money. Cash is going to go up. Cash is a debit balance. We're going to make it go up by doing the same thing, which is another debit. But we can't credit revenue necessarily under the revenue recognition accrual principle because we have not done anything to earn the revenue. We don't do anything until we perform the concert, and that will happen in the future. Therefore, instead of crediting revenue at the time we receive the cash, we are crediting a liability, an unearned liability. So this is an unearned revenue liability account, not affecting net income yet. Then when we perform a concert, one of the concerts, now we're going to reduce that liability. So the liability has a credit balance of the $5 million. We're reducing it by doing the opposite thing to it, making it go down with a debit. And now we get to credit the revenue that we have now earned for the concert that we have performed. Revenue has a credit balance. We're making it go up with a credit and therefore doing the same thing, which will make net income go up as well. So multi-period liabilities include unearned revenues and notes payable. So unearned revenues from magazine subscriptions often cover more than one accounting period. A portion of the earned revenue is recognized each period, and the unearned revenue account is reduced. So what they're saying there is we could collect for subscriptions that could be over a longer period of time and therefore have unearned revenue that we're going to have to account for, making the liability go down over several periods. Another common example of that happening is a notes payable. Notes payable often extend over more than one accounting period. A 3-year note period would classify a current liability for 1 year and long-term for 2 years. So when we take a look at notes payable, especially when we make the financial statements, we might have one note out there that might be for $1 million note payable that we owe to the bank, long-term liability, but we pay that note payable maybe off monthly, similar to like a mortgage. If that's the case, then the amount of principal that we need to pay off within the first year, within that year period, is current of that $1 million. We have to actually break that out into the current portion of the balance sheet. The rest of the note payable is over 1 year, and we have to have that in the long-term section. So what we're saying is these items could end up with a short-term portion as well as a long-term portion because of the fact that the liability extends beyond 1 year, but there are payment obligations within that 1 year.